Good afternoon from the floor of the CME. This is Chris Robinson with your Traders Exclusive comment for today. It's Tuesday. It's Thanksgiving week, so it's a short week. We will have Thursday off. Friday we'll have a half day. So just very quickly, I'm going to concentrate on 2 or 3 ideas and then get out of here and let you get back to planning for your turkey day. Number one, this Friday, even though we have a half day, it is options expiration day for the grains. So that really is going to affect December wheat and December corn. We could get a little action there. If you look at what the market's done, though, in corn and wheat specifically, corn is in about a 20-cent trading range, and we're just kind of waiting for a breakout, quite honestly. There's been no change in fundamentals. We got a pretty negative USDA report a few weeks ago. The managed money is roughly flat corn, possibly a little short. But again, if you take a look at that chart, we're right in the middle of our trading range. That's telling you that neither the bulls nor the bears have a really strong opinion at this point. Looking over at wheat, though, both Chicago wheat and Kansas City wheat, they're at one-year lows. So that market's at a critical level. There's still possible about 25, 30 cents to go to a contract low in the Chicago wheat. The managed money there is short, however. They're short about 65,000 contracts of wheat. Wheat continues to struggle with bad fundamentals, a lot of supply, higher than normal U.S. dollar. U.S. dollar, of course, has been in the news because it's been on about a 10% rally this year. That makes it harder for us to get on board any sort of export business. So wheat, we could get a little bit of action on Friday, although being the holiday, and I wouldn't anticipate very, very much. Switching over to soybeans. Soybeans, it's, what headline is going to move us next? It's all about, are we going to have a Chinese deal? Are we not going to have a Chinese deal? The soybeans are in about a 60-cent trading range. And that doesn't sound like a lot. If you're not familiar with the grains, 60 cents on a one lot is $3,000. So it's 5,000 bushels, 50 bucks a penny. 60 cents, there you go. So there's a lot of opportunity as this market whips around. And so if I was looking for one contract to trade in the grains, I'd probably be focusing on the one that's moving the most, and that is soybeans. So those are the options I would watch. We are going to have December options expire for soybeans as well, but really November options, which expired last month, were more important. Soybeans continue to just ebb and flow with the Chinese headlines. And very quickly, finishing up with crude oil and cattle. All right, the 2 C's. Cattle. We have a cattle on feed report tomorrow, Wednesday. So what is that? That's a fresh supply and demand report. The managed money there is bet long live cattle, fat cattle. So any sort of surprise there could force them to liquidate. A liquidation of longs would put pressure on the market. You also see a strong correlation between stock market volatility and cattle volatility. So as we watch the stock market whip around 2 or 3 cents every day, we've got 500-point moves in the Dow, 100-point moves in the S&P. That can sometimes spill over into cattle. So that's something to watch if you're a cattle trader, cattle producer. And again, we get the fresh data tomorrow after the close, the cattle on feed. So I would watch that. And then I've got to finish up with crude oil. Crude oil, in the past 2.5 years, we had a great rally. We started the rally at 26 bucks, went to just shy of 77, 78 bucks. That was a $51 move. Where are we now, and what are people looking at? If you just do a very basic math problem, halfway back is 51.50 roughly. So the market looks like it wants to go test that level. I would watch that carefully. And then obviously the $50 level, if we were to get crude oil with a 4 in front of it instead of a 5, that would, I think, cause people to reassess what their thoughts are as far as crude oil goes. But we have had a very severe sell-off here in the past 30, 31 days, what have you, just call it 5 weeks. The market's dropped over just about 30%. So what does that mean to you? If you had $100,000 worth of crude oil sitting in your backyard a month and a half ago, today it's worth 70. So that's a perfect example of why you need to hedge, or why, if you're a speculator, you really need to respect the risk. That's about it. I hope you all have a great Thanksgiving, a great Turkey Day, and we'll be talking to you next week. This is Chris Robinson. If you're looking for help, if you want some advice, look me up online.